For decades, China controlled nearly a third of global manufacturing, building everything from your iPhone to your face mask. Then one crisis shattered the world's supply chains. While leaders everywhere scrambled, India unleashed $100 billion in a gamble to seize industry from Beijing and redraw the map of global power. But can the world's biggest democracy really end China's reign? Or is the new manufacturing empire just getting started? By 2019, nearly a third of the world's manufactured goods came from a single country. Global corporations, chasing the lowest costs and the fastest delivery, built a vast web of supply chains that all converged on China. This system delivered record profits and kept store shelves stocked from New York to Nairobi. But it came with a hidden risk, a single point of failure. When the first wave of COVID-19 hit Wuhan, assembly lines worldwide went silent. Hospitals, from Italy to India, ran short of masks and ventilators. Electronics firms scrambled as shipments of semiconductors and circuit boards stalled at Chinese ports. For the first time in decades, executives realized that efficiency had become a trap. The world's just-in-time manufacturing model, optimized for cost above all else, left companies with no backup plan. The shockwaves were immediate. Auto plants in Detroit halted production, smartphone launches were delayed, and even the most basic medical supplies became scarce. The numbers told the story. China accounted for 28 to 30% of global manufacturing output, and there was no alternative with the scale or speed to step in overnight. Boardrooms in Tokyo, Berlin, and Silicon Valley raced to map their exposure, weighing the cost of disruption against the comfort of old habits. The pandemic did not just disrupt trade, it exposed how fragile the entire system had become. With every delay and shortage, the search for alternatives grew more urgent, setting the stage for a new kind of competition that would reach far beyond commerce and reshape the balance of global power. In June 2020, a remote stretch of the Himalayas erupted in violence as Indian and Chinese troops clashed in the Galwan Valley. 20 Indian soldiers died. For India's leadership, the message was unmistakable. Economic ties had not eased the threat from Beijing. Overnight, the government banned dozens of Chinese apps, halted major infrastructure contracts, and began reviewing thousands of imports. The impact rippled through boardrooms worldwide. Multinationals, already rattled by pandemic shutdowns, now faced the reality of rising geopolitical risks. Executives in Europe, Japan, and the United States began searching for ways to reduce their dependence on China. The phrase "China plus one" became a boardroom mantra. India, with its population of 1.4 billion and a workforce fluent in English, suddenly stood out. No other country could offer the same scale. Indian policymakers moved quickly, holding closed-door meetings with global CEOs and promising reforms. They highlighted India's vast consumer market, its growing digital infrastructure, and a government willing to put real money on the table. Unlike Vietnam or Mexico, India could match China not just in numbers, but in ambition. For the first time in decades, the world's largest democracy was no longer just a market for finished goods. It was pitching itself as the next great factory floor, a place where the world's supply chains could find resilience and security. The Galwan clash had forced a reckoning. For India's strategists, the old rules no longer applied. The race to capture the world's manufacturing future had begun. India's answer to the global supply chain crisis was not a tariff or a tax cut, but a direct cash offer. The Production-Linked Incentive Scheme, PLI, flips the usual playbook on its head. Instead of waiting for companies to invest and hoping jobs will follow, the government pays manufacturers a bonus for every extra phone, car, or solar panel made in India over their 2019 output. The rate is not symbolic. It runs from 4 to 6% of the invoice value, a sum large enough to erase the cost gap with China. The Ministry of Commerce, led by officials such as Piyush Goyal and Anup Wadhawan, pushed the plan through in the wake of the pandemic and the border clashes, targeting 14 sectors from semiconductors to electronics. The numbers are staggering. A government outlay of up to $30 billion is set to pull in $100 billion in private investment. The results are already visible. Before 2020, almost no iPhones left India for foreign markets. Today, Foxconn and Pegatron have built sprawling assembly lines in Tamil Nadu and Karnataka. Apple now exports more than $7 billion worth of iPhones from India each year, a figure that was unthinkable just a few years ago. The PLI scheme is not just subsidizing factories, it is buying entire supply chains, one contract at a time. Moving goods across a country as vast as India has always been a test of patience. Freight trains crawled behind passenger schedules, and containers piled up at ports waiting for clearance. To compete with China's legendary logistics, India launched the National Infrastructure Pipeline, a $1.4 trillion plan to rewire its arteries. At the heart of this effort are the dedicated freight corridors. On the western route, trains now run from Dadri to JNPT at average speeds of 60 kilometers per hour, more than double the old pace. What once took over 3 days can now be done in less than half that time. These corridors have already moved over 2 billion tons of goods, slashing transport costs and cutting delivery times for manufacturers. At the ports, the story is the same. Mundra and JNPT now handle the world's largest container ships, with turnaround times down to just 1.5 days. But the ambition stretches far beyond India's borders. The India-Middle East-Europe Economic Corridor, IMEC, is designed to bypass the choke points of the Suez Canal and the South China Sea. When operational, IMEC is projected to cut shipping times to Europe by 40%, moving goods from Gujarat to Greece in as little as 11 days. This is not just about speed. It is about building a supply chain that can withstand shocks, reroute around crises, and deliver goods at a price that rivals China's best. For Indian exporters, these new arteries mean access to global markets on their own terms. India's digital strategy is rewriting the rules of global influence. Aadhaar, the world's largest biometric identity system, now covers more than 1.3 billion people. This backbone enables instant verification for everything from bank accounts to government services. On top of it sits UPI, a payment interface that has processed over 14 billion transactions in a single month, more than China and the United States combined. These platforms are not just for domestic use. India is exporting its digital architecture to more than 20 countries across Africa and Southeast Asia, offering an open-source alternative to China's surveillance-heavy technology. Behind the scenes, a surge in data center construction is underway. Capacity has jumped 139% in just a few years, as global tech giants shift their storage from China to India to hedge against geopolitical risk. This digital moat is giving India leverage far beyond factory floors, turning software, identity, and payments into tools of soft power that attract investment, build trust, and lock in economic allies for the long term. India's trade deficit with China stands at a staggering $99.2 billion, a figure that casts a long shadow over every policy win and infrastructure upgrade. For all the headlines about new factories and digital breakthroughs, the reality is that most of the high-value components inside India's exported electronics are still stamped "Made in China." That dependency is about to face its toughest test yet. In 2024, the government approved an $11 billion investment for the country's first advanced semiconductor fabrication plant, a joint effort between Tata Electronics and Taiwan's PSMC. The facility, rising in Dholera, Gujarat, is designed to turn out up to 50,000 wafers every month. These wafers are the raw material for everything from automotive chips to power management circuits, the backbone of modern industry. The India Semiconductor Mission, led by a team of engineers and policymakers, is betting that this project will be the turning point, the moment when India stops just assembling and starts creating. If the plan works, it could begin to close the trade gap and set the stage for India to become the world's third largest economy by 2030. But the stakes could not be higher. Billions are on the line. And for the first time, the outcome will be measured not just in exports, but in independence from China's supply chain grip. Today, factories and data flows are redrawing Asia's power map. As global supply chains split, India's gamble challenges China's grip on technology and trade. What happens next will shape who controls the world's next generation of innovation and who sets the rules for everyone else. Your move, Beijing.